Welcome, everyone, to the Retire Young podcast, the podcast where we talk about the financial markets, how they work, and different ways that you can upgrade your lifestyle. And today I have a special guest with me, Dawson, commodities trader. How are you doing today, Don?
Doing great.
Good. It's great to have you. And before I get your take on what's happening in these financial markets, I always like to ask people, how did you get started trading and investing?
Mine was a very simple story. I just, when I was in the, Virginia, growing up and everything, had a little bit of blue-collar background, so family relatives had some farming and so on like that. So I just kind of got interested in it at a younger age, just through the physical side of the commodities. And then as I was just getting into my 20s, I guess, some people started talking about the stock market.
So that was about 5 years ago then?
Oh, yeah, 5 years. Yeah. And so, but I got a little interested in the stock market way back in the 80s, but it was so slow back then. And as a 20-year-old, it's just not fast enough.
Yeah.
So my broker, I was lucky. He was a commodity/stock broker. So I told him, I said, these stocks are too slow for me. What do you have? And he turns this old green phosphor monitor around. He goes, pork bellies, treasuries, gold. And I'm just going, wow. And instant love, And so I was married to market that day. So.
Nice. And that back then, the pork bellies and orange juice, and that was kind of the main things that was traded back then, wasn't it?
It was, yeah. Risky markets, but they're definitely ones to be trading. I guess you would trade, today we have things like DAX and what would be another super... I'm trying to think of another really bad or fast market, but pork bellies was one of those everyone had to do it once kind of a thing, Just to say, I did pork bellies, but it was a wicked market.
Yeah, why was it so fat? Was it so illiquid, or what was the reason?
Let's say it didn't have the liquidity in there to handle the trades that were coming in, because you think you got your hedgers in there, people like Jimmy Dean, SK, all those guys who were doing bacon and all this stuff, pork bellies, and then you got the speculators who were in there. So it was pretty volatile, but it's not like today where we had so much volume at every price. So it didn't take it much to make a fast run. As a matter of fact, there's things in physicals like limit ups and limit downs, which you've seen like the movie Trading Places.
Dan Aykroyd and Eddie Murphy. Great movie, by the way.
Yeah, very funny movie. But anyway, in there, pork bellies, at one point you could see them one day be limit up and the same day limit down.
That's crazy.
It's a huge. It was a $4 move up and down. It was like, holy cow. But you didn't trade that regularly. It was just one of those days where you felt like, I'm going to trade pork bellies,
Yeah.
And you did it once or twice and you said, okay, I'm done with that market. So.
Yeah. That's amazing how things were back then with limit up and limit down. I mean, it doesn't happen like that. I mean, they have the shut off now.
They do. Yeah. We got the cattle, and we got rid of the pork bellies, but live cattle, lean hogs, and the feeder cattle, we still have the limit moves in, and the grains still have the limits. But we see them more in a live, like yesterday, for example, lean hogs are actually limit up. There was some news coming out about China or something like that. And so that was impacting that market. But that market's down to a 4-hour day now. It's a very difficult market for overnight, holding them overnight, because remember, one of the biggest...
It's just like the stock market then.
Right. 7 hours, people worry about gaps in the stock market, but this is only 4 hours. So you have to be kind of careful holding them overnight. But you can do things like spreads to hedge your position. So if you're in a spread, and let's just say if you were long and short a lean hog, 2 lean hog contract months, if the thing opens gap limit down the next day, you're going to lose there's a $3 on one contract, but the one you're short, you're going to make $3, so you're at the same price you were yesterday when it gapped or before it closed.
Sure.
So that's the safety of using a spread trading those kinds of markets.
Got it. Okay. Do you still participate in those type of markets a lot now, or you stuck more on like the?
No, I do a wide range of markets. Like I trade more of the physicals than I do the financials.
Okay.
So I find the physicals are more of a tangible asset. It's things that we have to have every
gold,
day.
oil, silver, stuff like that.
Grains, stuff like that. It's foods, building materials, stuff like that. We got to have them. So there seems to be floor prices, they call production cost in there and stuff like that.
Yep.
Whereas a stock literally could go to zero, and nothing says it can't.
We've seen that happen.
Right, but you can't think about it. Oil's not going to zero, gold's not going to zero. So there's these costs to produce these commodities. So it makes it more of a tangible asset, a little easier to grasp the price movement.
Yeah, I mean, when people are starting to get in the financial markets, you need the confidence to do that. When you first started, how did you get to that point where you're comfortable and confident to just be able to follow your plan?
Yeah. In the beginning, obviously, I didn't have a plan. I was shooting from the hip. But the one thing I did do was I was coattailing my broker. He was kind of, I don't want to call him a mentor, because the guy had very, very deep pockets.
Yeah.
And I watched him trade pork bellies, and they were going limit down for like 3 days in a row. And every day he would buy them. And I was no genius at that time, but I knew he was losing some money. So I'm going like, don't you think you should be getting out of this thing? He goes, nah, it'll be back. Before he got out, he was up 30,000 on that trade.
Yeah.
So that's how you do it. You keep buying as it goes down, or keep selling as it goes up. Well, that's good if you got the money. But when
Yeah.
you're a small trader, you can't do that because it will wipe your account out.
Yeah, because
So
of the
I
margin.
got off to a bad start watching him do like that. And
Sure.
so then it was more about just going and studying. And I'll tell you, here, talk about time ago. We didn't have the internet. It was libraries. Remember those things you pulled a book all over the shelf?
Yeah, those one thing. Yeah, a lot of people listening probably don't even know what that is anymore.
Oh yeah, I was telling a class recently about there was a toolbox I handed out that says a bunch of articles I had written, and I said, just think of this as a reference disc. I said, or a better way, just think of this as an encyclopedia. And I had a class full of millennials one day, and they're sitting there and they all looked at each other like, a what?
Yeah. Do you remember we used to have those things on in our bookcase? Everybody had an encyclopedia. It was a big thing.
Yeah, talk about me. I should say, well, just go put it on a floppy disk. I would really put my age out there, right?
Yeah. Yeah, that's awesome. No, we mentioned a plan. I mean, a lot of traders and investors do start without a plan. Why is that so important? Because, emotion. There's a lot of emotion in it.
That's right. If you don't have a plan, that's all you're going to trade from is emotion. It's like shooting from the hip, and there's no consistency in that. The thing about a business, and that's what trading is, but most small businesses fail, don't have a business plan.
That's true.
The same thing happens in trading. If you don't have a trading plan, you're not, we don't guarantee success at this by no means. But one thing I guarantee people is without a plan, it's failure. That's what's written on the wall for you. What a plan does, it lays out step-by-step process for you to do consistently. Each trade you sit down, you do step 1, 2, 3, 4, and once you go through those steps, then if something's not working over a period of time, you kind of know what to go back and fix because you've been doing the same thing every
You can
trade.
evaluate them.
Right, exactly. So you know what section is weak. The other thing I'd like to tell students too is when you have a trading plan, you first write the trading plan, is you're going to write it out and then you're going to practice with it and you're going to find your weaknesses in your trading plan, meaning as you go through the process of setting a trade up, where do you stumble? Where does it stop you at?
Yeah.
That's where you start you going back to a retake on a class or you start going through your XLTs, whatever. You're honed in on that part of your trading plan. I need to enhance that part of my plan because maybe I'm okay on trend or maybe I'm okay on curve, but I need some help on finding low time frame zones. So you hone in on that because you know that's your weak spot. Without the plan, you really don't know your weaknesses and strengths, right? So,
Sure.
So the plan is very, very important. And I think I'd like to just say for people writing a trading plan, as you come through Online Trading Academy, we have something called a core strategy reference card.
Yeah.
And it's literally got step-by-step on there of the process we're laying out. And down at the bottom, there's a flow chart down there. And that's what you want to do, is just to write out a very simple little action trading plan.
Yeah.
And then even as basic as 3 rules per section on there. And I tell people this isn't going to be what you're using a year or 2 years from now, because in that time, you're going to be doing more advanced stuff because you'll learn more going through your trading career. But this is just your starting point. You got to have somewhere to start.
Yeah, and that's important too, because you're here in Minneapolis actually teaching a class, futures class, and you were doing a trader group for a lot of students last night on commodities. Talk a little bit more about commodities, because you've actually done a lot of commodities trading, and you're actually going to be coming here to do a commodities class down the road.
Right.
Explain the commodities markets, why that's so beneficial, and then especially in that trader group, how are you helping people be comfortable with the commodities?
Right. Yeah, it is. Most people, they've all had relatives or friends tell them about how a great uncle had somebody banging on a door on Sunday morning going, here's pork bellies, where do you want them put?
Physically delivered, right?
Exactly. And unfortunately, that doesn't happen in the markets. I mean, even if you do get assigned a delivery, which is highly unlikely because today's electronic brokerages would have you out of a trade before that would happen.
Yeah.
But even then, think about it, no one's going to fill up a tractor trailer full of meat or lumber or anything, take it to someone's house who lives in a condo, knowing darn well they're not going to unload it. So that just kind of says they're not going to be banging on your door. At least they won't wake you up anyway. But anyway, the physicals, I think, just have that sort of bad history of people talking about that, and it's really not.
They just didn't know how to use it back then.
Right, exactly. No one had risk management. People literally open a $5,000-$6,000 account and buy something, and no stops, no nothing, and zero in their account became their stops. And of course, they blow them up. And of course, futures are bad. That's gambling. Blah blah.
Yeah.
Everything is if you don't have risk management, right?
Yeah,
so
that's the most important piece.
Casinos, that's the same thing. If you don't have risk management, you throw all your money away, and you're gambling with no rules or no strategy. That's what's going to happen.
Well, having that strategy, you actually are the casino then, because you're doing the same thing over and over.
You're putting the odds more in your favor.
Yeah.
That's the purpose of the plan. So that you have some consistency with the odds in your favor. Otherwise, you are gambling if you don't have the rules, right?
Yeah.
So, but anyway, with the commodities, it's such a cool thing. I mentioned earlier, a tangible asset. We got to have them every day. Whether it's food or energy, clothing, any of that stuff. And it's really a nice thing because as you're trading commodities, they're very cyclical by nature too, more than say a paper asset. Paper assets can be cyclical, but the physicals are even more. Because think about it, you put crops in the ground at the same time every year, and it takes X number of days for them to be, ready to harvest. And so they come out of the ground at the same time every year.
Yeah.
So that creates cyclical highs. So for example, just as an example with corn, May, June, you typically find those are your high prices. October, November, and the harvest season, those are your low prices. So as a trader, if we're aware of those highs and low times of the years, we can kind of plan ahead for some trades, whether longer term trades or even just multi-days of trades that we're into. You can plan ahead for what you think, tied into that.
Yep.
There's commercial entities that are really heavily involved in the commodities markets because they're producing these commodities or they're going to refine the commodity. For example, in the corn market, you would have somebody who grows corn that would be producing it for you. And then your processor or refiner would be somebody who's like an ethanol producer or a rancher who needs to buy corn for feed. And we're exporting corn all the time. So there's two different types of commercials on there. One looking to sell, one looking to buy.
Yep.
I was trying to think with the commercials coming into this play and the seasonality, there's an analysis technique we can use, something called commitment of traders report. And what it does, it reflects the position of the commercials in a market, whether they're very bullish or very bearish. And if you think about seasonality, the commercials probably make a lot of the seasonality in there anyway because they're using the physical commodities day in and day out.
Yeah.
But if you tie in like a seasonal high, for example, in May, June, if you look at this report we talk about a COT, if the commercials are very short, coming into May, June, that confirms that seasonal's got a very good chance of working this year.
Sure.
It's an extra odds enhancer.
Yeah,
One odds
that's
enhancer.
what it's all about.
Right. Then with the core strategy, once we have a trend that confirms we're starting down, now we have three things in our favor.
Yeah.
And then we put risk management in it, and there we are off for a trade. So that's, I think, with commodities, we have that edge of seasonality, the commercials, and then obviously core. Now, the OTA strategy can be used across futures, forex, or options, but when you can add extra odds enhancers like the commodities, commercials, and the seasonality, I think it just puts an extra twist in there in your favor.
It is, and that's what it's all about, just having more odds in your favor, low risk, high reward, high probability.
Exactly.
It's not a be right every time game.
Oh, you're not, exactly.
You
We
know.
would never even say that either, but it's it puts the odds a little bit more towards winning in the market, and when you do lose, the losses are typically they're meant to be smaller, and the winners are meant to be bigger from letting the profits run.
Yep, that's awesome. You'll be back in a few months teaching that commodities class here in Minneapolis at Online Trading Academy, and I appreciate you coming in and taking some time chatting today. And we will see you in a few months in that commodities class.
Sounds great.
Thanks a lot, Don.
All right.
All right.